Hi everyone, welcome to today's webinar, How Robust is Your Trust? My name is Karen Tobeck and I'm a partner at Monte Carlo Chartered Accountants. I'll be your moderator today. For those of you who are unfamiliar with the webinar environment, these are the Zoom settings. Let's take a closer look at the webinar controls. Select audio settings to select and test your speakers. Submit questions via the Q&A button. We will send out the questions and answers after the webinar. Click Leave Meeting if you need to leave at any time. Now I'd like to introduce today's presenter. Glynis Carter is a partner at Monte Carlo Chartered Accountants and has been since her firm Corbett Carter merged with Montec Group in 2013. Glynis is a trusted advisor to many with a particular area of expertise in the use of trust and their administration. Since the early 1990s, Glynis has been appointed as an independent trustee on a number of client trusts. Welcome, Glynis.
Thank you, Karen. Hopefully everybody can hear me. If you can't, can you just please signal to us? And thank you to all of you for taking the time to join me today. We have a lot of attendees, which tells us that this is very much a hot topic at this time. As Churchill put it, savings are a marvellous thing, especially if your parents did it for you. It's important to plan ahead, and now is a good time to be thinking about your trust. There are questions we need to be asking ourselves about our trusts, particularly with the new trust legislation that comes into force in January 2021. Will our New Zealand love affair with trusts remain? My prediction is that it will. However, there will not be one outcome for all. So let's see what you think at the end of this session. Whoops, knew that might happen. Let's just work out how we go back here. Right, now we need to go forward again. Next. So, what are we going to talk about today? Before we get stuck in, I just want to throw in our usual disclaimer that the information in this educational webinar is general in nature and no substitute for tailored advice. Everything should be specific to your particular circumstances. Over the next 45 minutes or so, we'll discuss why trusts are so popular in New Zealand and the risks that trusts can protect against. We'll address the impact of the new Trust Act 2019, and we'll look at the issues we've identified during recent trust review work we've completed. Finally, we'll look at a few technical issues around memorandum of wishes and powers of attorney. Then we'll cover your next steps and how we can help, as well as dedicate some time to answering questions you may have. So, I did get told one click would move it forward. Why did you set up your trust in the first place? With the new trust legislation coming into force, now is a great time to consider whether the reasons you set up your trust are still relevant and if the benefits outweigh the costs of compliance. Most likely your trust was set up to protect assets, reduce risk exposure, provide tax savings, and to provide an enduring benefit to yourselves and other family members. Let's look at each of these areas in a little more detail. Asset protection is one of the most common reasons for setting up a trust, and is still a very valid reason. Trusts are often used as a place to hold assets such as your family home, holiday homes, investment portfolios, and other high value assets, maybe even farms. By transferring your personal assets to a trust, they can be protected against certain risks, which we will cover shortly. A trust can also be used as a vehicle to own shares in your business activity and to hold life insurance policies so that in the event of death, the proceeds of the insurance go directly to the trust without having to be gifted off. The risks that you're trying to mitigate often relate to being in business. There are risks around employing people, health and safety, commercial risks such as the ability to pay creditors, the bank and the IRD. Even if your business is a limited liability company, there are circumstances where you may be personally liable as a director, putting your personal assets at risk. Trusts are also useful to protect against relationship property claims or poor financial management by the next generation. Equally, a trust could be a way of reducing exposure to the government. In the past, trusts were used to help access rest home care subsidies. However, new rules under the Social Welfare Act make this almost impossible to claim now if you have assets in a trust. While we don't currently have estate duty or capital gains tax in New Zealand, a trust could be a way of reducing exposure to these if they were to be implemented in the future, maybe even a wealth tax. So the questions to ask yourself now should be, are those assets still needing to be protected? And are you still exposed to the same areas of risk? For example, if you no longer have a business activity and have no bank debt, you are likely not exposed to creditor or bank risk, so may no longer need your trust. On the flip side, you may now have more equity or wealth and other reasons to protect that, such as from relationship property claims or beneficiaries who may have poor financial management skills or even addictions, meaning that the trust is still of value. Assuming the trust is still valid, a trust review will identify any issues that need to be addressed to ensure your trust offers the necessary asset protection and risk mitigation. There also may be tax savings to be had using your trust. Trust income is taxed at 33%. However, beneficiaries will pay personal tax at their marginal tax rate on any income distributed to the beneficiary from the trust, as we see it as beneficiary's income. This means that if a beneficiary's tax rate is lower than 33%, tax savings may be made by allocating trust income to beneficiaries. On the horizon is the Labor government's promise of a tax increase for high income earners over $180,000 from 33% to 39%. While a trust cannot be used for assigning personal earnings such as salary and wages, a trust still may become useful for capping the tax on investment or business income at the 33% rate. It is important to note that if the only reason you're using a trust is to access tax benefits, your trust may not pass scrutiny by IRD. Tax savings should be incidental to the other benefits of having your trust, not the main reason for having it. If you set your trust up to provide an enduring value to family members, you need to think about the next generation and what their expectations are. Consider questions such as, are the beneficiaries old enough to manage assets if they are transferred to them now? Are the beneficiaries financially mature? Could they be exposed to relationship property claims? Do you want to ensure that future generations, e.g. grandchildren and great-grandchildren, are provided for? A trust has the advantage that assets don't need to be transferred immediately upon your death. They can be held in trust to be distributed in a way that may preserve the capital for the longer term and protect assets until beneficiaries are old enough and financially mature enough to manage them. Also, holding assets in a trust can be a great way to protect assets from relationship property claims, as the assets may not become intermingled property. So, in order to really understand what the trust is all about, we need to look at some important terminology. I know a lot of you have already got trusts, probably the majority of you, and this might be going over old ground, but I think it's worth just clarifying and making sure that we're using the terms in the right way. The settlor sets up the trust and typically transfers property into the trust, providing the value either over time or in one lump sum. For example, mum and dad may be settlors because they transferred their family home into the trust at market value with an on-demand debt owed back to them. That debt would have, most likely, been recorded as a deed of debt, which was gifted away over several years. When the gifting rules changed in 2011, the debt may have been forgiven in full, or it may have been extinguished upon the death of either mum or dad. The trustees are the people who are charged with looking after those assets for the benefit of the beneficiaries. Often mum and dad are trustees as well as settlors, along with a third person, such as a professional trustee or a trustee company. The beneficiaries are the people or organisations that the trust assets are being held on behalf of, usually mum and dad, their children and grandchildren. Beneficiaries can also include other family members, friends, charities, or trusts for the benefit of beneficiaries. A trust for the benefit of beneficiaries allows assets from one trust to be transferred to new trusts. For example, assets from mum and dad's trust can be transferred to two new trusts, one for each of the two children. The last class of people to consider are the appointers. These are people who have the power to appoint and remove trustees and beneficiaries. And clearly, if they have that power, then they actually do have power over the trust. A useful way to remember the types of people referred to on this slide is to think about the origins of trusts, which date back to the Crusades in the 12th century in Britain. During the Crusades, the knights would transfer their land to the monks of the local church to hold, so that if the knights were killed, the land was still available for use by their families. So in this example, the knights were the settlors who passed their land over to the monks, who acted as trustees, holding the land for the benefit of the wives and children of the knights. Now it's time to review your trust to determine whether the trustees are still the right people. Are they too old? Are they retired? Should they be your adult children? If so, which ones? Are the beneficiary classes still correct? Should they be condensed? Are there classes we should now remove, or some that should be added? And are the appointers still able and willing to act? And will they be comfortable with the responsibilities that they are assigned? Being able and willing to act is even more important given the requirements of the new Trusts Act 2019. We must also think about what happens if one of the trustees or appointers dies. Who will the powers be transferred to? These are the technical questions you need to be thinking about. And if it is too overwhelming, we can help you. This is all part of our trust review. The trust deed is extremely important as it sets out the terms of your trust. You must ensure that these terms comply with the new legislation. Your trust deed appoints the trustees who will look after the trust assets until the trust is wound up. There are certain duties that the trustees must abide by under the Act, and others which may be amended by the trust deed. We'll look at these shortly, but it's important that you review the duties and decided whether any of the default duties should be amended by the trust deed. The trust deed is also where the beneficiaries are identified. These can be specifically named in the trust deed, for instance, John and Jane, or the wording can be wide enough to include all children, grandchildren, and great-grandchildren to cover anyone who may not be born when the trust is set up. Often you'll see the word issue. It also allocates the power to appoint beneficiaries and trustees. It's important that the trust deed is clear as to who has these powers and how they can be used. Finally, the trust deed will set the vesting date of the trust. This is the date upon which the trust will be wound up and the trustees will no longer hold the assets. Previously, trusts had a maximum life of 80 years. However, the Trust Act 2019 allows up to 125 years. It's important your trust deed is clear on this date and what will happen to the assets of the trust on that date, and also whether you can actually modify your current trust and change that. So there's a few common issues that we've found with trust deeds that we've picked up while we've been doing trust reviews for clients. If your trust is relatively old, it's likely to be less flexible than a modern trust. This could mean you're unable to make the changes to your trust that you'd like to. For instance, such as changing the vesting date or adding grandchildren as beneficiaries. If this is the case, Does the trust deed allow the trust to be resettled into a new one? It's important to note that resettlement must be for the benefit or advancement of one or more of the beneficiaries of the trust. We have to also be careful that if a new trust is created, that we don't create any tax issues by this resettlement. Would the Inland Revenue see that resettlement into a new trust as a completely new trust or just a resettlement of the old one? Issues may arise with who has the power to add beneficiaries. If both mum and dad have the power to add beneficiaries and one of them dies, should the other retain this power? What happens if the surviving parent forms a new relationship with someone with children? Is it okay for him or her to add these children as beneficiaries? Or if the surviving parent has a falling out with one of the children, should they be able to remove that child as beneficiary? You'd want to make sure you were one of their favourites. There are no wrong or right answers, but these things need to be considered and recorded in the trust deed. Another issue we sometimes come across is the beneficiary classes not being wide enough, leading to a situation where the trust needs to be wound up, but the beneficiaries aren't clearly defined or there aren't any surviving beneficiaries. Lastly, you need to think about who has the power to appoint trustees after you die, either to replace you as a trustee or where an existing trustee may become unwilling or unable to act. Oh, as you can see, there's a lot of things which your trust deed should cover, some of which you may never have thought of. It's important that you take the time to review the trust deed now and ensure it represents your true intentions for your trust. So we talked about the beneficiaries. It's important that the beneficiaries are clearly identifiable. There generally are two classes of beneficiary, discretionary and final. Discretionary beneficiaries can only benefit from the trust at the discretion of the trustees. A final beneficiary will benefit upon the wind up of the trust if there are any assets left in the trust at that time. One thing to consider is whether the beneficiaries of your trust are still appropriate. Maybe you set up the trust before you decided to have children, or perhaps you're no longer as close to a particular sibling. Some beneficiaries may be independently wealthy while others are not. And watch out for spouses being included. We used to add in a whole raft of beneficiaries so the trust would not fail, but now it may not be so wise to have everyone at the party. Another thing to consider is how beneficiary loan accounts are treated. These may arise where you've transferred income to some beneficiaries to make tax savings, but haven't yet paid out these amounts in cash. Or you may have paid out cash to some beneficiaries, but not to others. For example, let's say your daughter attended university while your son moved straight to employment from school. You may have allocated income from your trust to your daughter while she was at university, as her marginal tax rate was low. But you didn't do this for your son as he was earning income. In this example, your daughter may have a large balance of funds technically owed to her, and your son may be owed nothing. You need to consider how these different loan balances are to be treated. On a similar vein, large balances owed to trusts can build up in trading companies. This happens where profits are credited as dividends to trusts, but not paid out in cash because the company has been using that for its working capital. In this instance, it's a great idea to have security in place so that if the company gets into financial difficulty, the trust is a secured creditor with the ability to be repaid before unsecured creditors. Lastly, especially in the current economic climate, it's important to review the investments the trust has made to date. It may be that the strategies adopted in the past are not appropriate now, or that you have other investments that may sit better either in the trust or other entities. What I'm getting at here is that with the transparency available to beneficiaries, trustees are going to have to be more proactive in their investment and utilisation of trust funds. If the trustees make a risky investment and lose money, Could the beneficiaries sue them? Likewise, if the trustees choose to invest in risk-free and low returns, currently 1.4% on term deposit, could it be said that the funds didn't grow enough? Really, the trustees are going to be caught between a rock and a hard place. So let's come to the impact of changing legislation, which is what you have all really all zoomed in for, is what's going to change. And why do you need to review all your trusts to ensure that they're fit for purpose? The Trustees Act 2019 replaces the Trust Administration Act 1956. So that's quite some years ago, and it codifies a lot of what existed only in case law. By codify, we mean puts into legislation. I tell people that it's really taking what is best practice and making that law. There are an estimated 300,000 to 500,000 trusts in New Zealand, so the new legislation will have a big impact. It comes into force on the 30th of January 2021. However, this is the date that your trust must be compliant by. So you need to act now to ensure your trust is up to speed. Let's run through the key changes. A lot of these trustee duties already existed under case law, but we've now got clarity about what the expectations are. And as a trustee, you must ensure that you're complying with these duties. The Act specifies two types of duties, mandatory and default. Mandatory duties apply regardless of what the trust deed says. Default duties apply unless they're modified or excluded by the trust deed. Let's have a look at these duties. So remember, these are the duties which cannot be contracted out of using the trust deed. They apply irrespective of what the trust deed says. Trustees must know the terms of the trust, act in accordance with those terms, act honestly and in good faith, act for the benefit of beneficiaries or to further the permitted purpose of the trust, exercise powers for proper purpose. Just think about those for a while. Know the terms of the trust, act in accordance with those terms, act honestly and in good faith, act for the benefit of beneficiaries, and exercise powers for proper purpose. Well, that doesn't sound too hard, does it? However, how long since you read your trust deed? Do you really know what the terms of that trust is? And that's your very, very first mandatory trustee duty. So the default duties must be performed unless they're modified or excluded by the trust deed. You can't just assume that you've modified or excluded them. You need to check the trust deed, or you need to modify the trust deed. Most of them are best practice and should be performed. However, some are commonly modified. Acting with a duty of care, investing prudently, and not exercising power for the trustee's own benefit should really go without saying. To actively and regularly consider the exercise of trustee powers highlights the importance of holding regular meetings and recording evidence of those meetings. Not committing trustees to future exercises of discretion means that you can't force income or capital to be allocated in a certain way in the future, for example, for one beneficiary over another. Those discretions have to be made by the trustees in the time. Avoiding conflicts of interest sounds obvious, but it's important that decisions are documented, particularly where there is a potential conflict. The duty to act impartially doesn't mean that trustees must distribute trust assets equally between beneficiaries, but that they must act impartially in the management of trust assets. The duty not to profit from the trusteeship and to act for no reward may need to be modified where trustees are being paid. And obviously, if you have a professional trustee, you may well be needing to pay them a trustee fee. And lastly, the duty to act unanimously. It's important to document decisions to prove they were made unanimously if this duty is not modified by the trust deed. Some trust deeds will have some decisions that have to be unanimous and others that only need a majority. Again, these duties don't seem too onerous, but it is important to be able to prove that you have acted this way. So it is extremely important to minute decisions and to keep your personal and trust affairs separate. You must have a separate bank account for the trust that is properly operated, not simply used as if it's your petty cash. Now the biggie. The most controversial part of the legislation is this. The Act has introduced requirements for beneficiaries to be able to access certain trust information. This is to ensure that beneficiaries have enough information to be aware of the terms of the trust and enforce trustees' duties against the trustees. So just repeating that, enough information to be aware of the terms of the trust and enforce trustees' duties against the trustees. There is a presumption that trustees must notify all beneficiaries of basic trust information. This information includes the fact that a person is a beneficiary of the trust and the name and contact details of the trustee or ease, and the occurrence of and details of each appointment, removal, and retirement of a trustee as it occurs, and the right of the beneficiary to request a copy of the terms of the trust and other trust information. This is a significant change, as previously trustees didn't need to inform beneficiaries that they were beneficiaries of the trust at all. If the beneficiary is a minor under the age of 18, then the child's guardian should be notified. And that's okay if they're also a beneficiary of the trust, but you may not want the child's guardian knowing about the trust. The other trust information may include the trust deed and what property or funds the trust holds. Each of these presumptions won't apply if the trustee reasonably considers that the information should not be provided, taking into account certain factors, such as the nature of the interests held. By that they mean, are they a final beneficiary or are they just a discretionary beneficiary who may never actually benefit from the trust? Whether the information is subject to personal or commercial confidentiality, the expectations of the settlor at the time of the trust's creation as to whether the information would be given, the age and circumstances of the beneficiary, the effect on the beneficiary of giving the information, which makes you think about the Stephen Tyndall presumption that he would only provide his children with a certain amount of money because he wanted them to actually go forward in the world and try to make go their own way in life without waiting to inherit. The effect on trustees, other beneficiaries, and third parties of giving the information, and the practicality of providing the information and safeguarding the information. Can you imagine if you've got a very wide group of beneficiaries and you're passing around information that may be sensitive? I also want to add that there is a presumption that the trustees will do this, but there is no penalty per se in the Act if they do not. However, you will have to consider and document these decisions in case there is a dispute in future and it is found that you've wrongly withheld this information. You can't withhold the information just simply because it's going to put the trustees in a bad light. So that brings us on then to record keeping, because it's difficult to give information if you don't have it. Another significant change is that the trustees must keep a copy of core documents relating to the trust. If there's more than one trustee, each trustee must keep their own copy of the trust deed and record any of the variations. One trustee must keep the other required documents, which must be made available to the other trustees on request. When a trusteeship ends, the trustee must pass on the documents they were holding to another trustee. Trustees must keep appropriate records of property and records which identify the assets, liabilities, income and expenses, contracts, and other accounting records. This may seem obvious, but many trusts do not keep accurate records. For some, it has been that the sole asset is the family home, and the trustees have felt that there is no need to keep these types of records. How the asset is definitely easily identifiable, but the liability may not be. Was the bank owed for that home? Was it the settlor? Has it all been gifted off? Has the property been replaced and a capital gain made? Just filing a tax return will no longer be sufficient, if in fact it ever was. And most certainly, minutes and resolutions of all of the trustees' decisions need to be kept as well. They do not necessarily need to be released to beneficiaries, but you will need to have them if you should ever get into strife. So the other significant changes in record keeping, through the legislation, is that there is now a limitation of liability for breach of trust. So the trust deed must not limit or exclude a trustee's liability, nor indemnify trustees for dishonesty, willful misconduct, or negligence. I have to say that I've never seen a limitation for these in practice, and I can't see why you would ever want to have had it there in the first place, because surely if the trustee is acting dishonestly with bad misconduct or negligence, you would want to be able to actually make them personally liable. The other thing that the Trust Act introduces is a new dispute resolution. It's an alternative dispute resolution process. It's mediation. It's set out in the Act. It covers disputes between trustees as well as beneficiaries and trustees. The courts have been given wide powers to review acts, omissions, and decisions of trustees, but that is, of course, expensive and best avoided. So what can help you stay out of trouble? It's best practice for settlers to produce a memorandum of wishes. This is a bit like a will for your trust. It's not binding on your trustees, but it states what you'd like to have happen to the assets during and after your lifetime. It's important that you keep this up to date to avoid potential dispute. The memorandum of wishes should be reviewed every 2 to 3 years, and it's easy to change. If you've created your memorandum of wishes 20 years ago, it may well no longer be appropriate. I mean, your children will have been far younger if they actually existed at all. What do you want to happen to the trust when you die? Should it be wound up or should it continue? This will also change over time, because at the time that you set it up, you may have wanted it to continue, but now you think that you could pass this wealth through to your adult children and they can look after it themselves. All of this should be set out in your memorandum of wishes. It should also state how you want the beneficiaries to be treated. Take the earlier example. A daughter had gone to university using trust funds to pay the fees, and a son went straight into work. Should the son receive more when the trust is wound up to make up for the money the daughter received? Or was the money given on a use it or lose it basis? So there should be no adjustment made to bring the two into equality. Everybody has a different opinion. Likewise, do you want to keep some of the trust funds set aside until your children reach financial maturity? Would you prefer to loan funds for a deposit on a house or gift money outright? Of course, if it's gifted outright, it can become relationship property for your children. There are no right or wrong answers here. Each trust and family situation will be vastly different. What's important is to get the documentation right so that it reflects your intentions, and it's something that we can help you with as part of a trust review. We talk about these a lot, and hopefully you all have them. But if you don't, then we would firmly recommend that you do something about getting them in place. There's two main types of powers of attorney. A general power of attorney is temporary and could be used to allow someone else to manage your affairs, for example, while you're overseas. At the moment, chance would be a fine thing. This ceases to be valid when you no longer have the capacity to instruct the attorney. Enduring powers of attorney lets you decide who can make the important decisions about you if you're unable to do so because of accident or illness. It's important that you appoint your powers of attorney while you have the capacity to choose who you want to act on your behalf. There are two types of enduring powers of attorney. One is for your financial affairs and property, and one is for your personal care and welfare. You may have appointed people in the past that are no longer appropriate, maybe because they're no longer alive. We must consider the need to have powers of attorney in place and be sure people are familiar with the responsibilities that they have in this role and are willing and able to act. Other things to think about in terms of the validity of the trust and the need for it include your will. Have you reviewed it recently? It might be out of date and therefore no longer consistent with your trust deed. For example, you may have specified in your trust deed that the power to add and remove beneficiaries is transferred from you to the person specified in your will, but your will might not actually specify who this is. That equation is quite circular. Or you may not have specified in your will what you want to have happen to debts owed to you by your trust. Perhaps you want to forgive all debt, or maybe it would be advantageous to transfer the debt to your spouse. Do you have personal assets outside of the trust that should be moved into the trust? This is particularly important if you're in business or have acquired significant assets since the formation of the trust. Sometimes you will have also inherited a personal asset or assets, and you may want them to be transferred to the trust as well. Have you got the most appropriate structure for asset protection and tax planning benefits? For example, if you're considering winding up your trust, do you need a different entity, such as a company, to hold any of the assets? These are all issues we can discuss as part and parcel of a trust review to make sure that your trust mitigates as much risk as possible. So what are your next steps from here? We'd like to suggest that doing nothing is not an option. This trust legislation, as we said, does come in January 2021, 31st of January 2021, and your trust should be compliant by then. So make a clear plan as to how you'll ensure that your trust will remain compliant, if it is already. And remember that we're here for you and want to help. The information in this educational webinar I'll just catch up, shall I? The information in this educational webinar is general in nature and no substitute for specific tailored advice and support. There are several ways that we can help you more specifically beyond today's webinar. We list there a trust review, which helps to go through some of the issues that we've posed in today's seminar with you, and just basically sets out a plan of where to from here. What things do you need to work on to get your trust compliant? The trust administration is an annual fee, and we can do the trust administration for you. We will look at what the trust actually owns and how much activity it has, and we will quote on that for your particular trust. Likewise for acting as a professional trustee, if we don't already. And we can send you, if you wish to, I think actually they're going to send these out regardless as a follow-up of the webinar, is a checklist for you to actually go through and see what it is that you might need help with. So the main questions to ask are, do I still need my trust? Because it is clearly going to be more expensive to run. And who are the right people to ensure it continues providing the benefits I want and need? Answering these questions properly will ensure that your trust remains compliant. There are several ways we can help you with this. If you're not sure if you need a full trust review, we will send that checklist out. And then from there, we can take the next steps with you. As I've said, doing nothing is a potentially risky strategy. Having some sort of review is going to give you greater confidence in your very unique situation.
Thanks, Glynis. We have had a question come through about the minor beneficiaries. I think that was answered during the seminar, but if anyone, if anyone is still unsure about that, let us know. If you have any other questions, please contact us with any questions. Thank you for attending, and we'll be dropping a recording of this to all of you, be available to you, and also, as Glynis said, we'll be sending out the so that you can have a look at how robust is your trust. Thank you, everybody.